Hey, want to find out what's going to happen next year? Well, follow me and let's find out. I am Justin Miller, principal and co-founder with the Chong Miller Group. At the Chong Miller Group, we help people build wealth through real estate. Every year, I put out a forecast video for what's going to be going on in real estate in the following year. And so as I record this, it's the very end of 2024, and this is the forecast video for 2025 real estate here in the Las Vegas Valley. Okay, so this is how we're going to work through everything. First, we're going to look at really quickly what happened in 2024 so that we all have a level understanding of what the playing field is as we look at real estate going forward. Second, I'm going to look at the macro factors which are impacting real estate. Third, I'm going to be looking at the region-specific, the Las Vegas area-specific issues that will be impacting real estate in 2025. And then we'll get to the forecast, along with a couple caveats related to things that may challenge the forecast. So before we dive into the content, let me give you a really brief introduction of who I am, especially for those of you who are new to the channel and have not watched my videos in the past. So I am Justin Miller. I have a PhD in business with theoretical specialization in both sociology and economics. I also have PhD level training in econometrics. Econometrics is a predictive science using statistics. So a lot of people put out statistics at different times, and that's great for looking backwards. Econometrics actually uses statistical tools as modeling for what may happen into the future, and then back tests those same tools to figure out what the predictive values are with regard to the particular variables we may look at, the influences of each of those variables. And so I have very in-depth applied knowledge with regard to statistics and its forecasting modality, econometrics. Okay, so that means if you want to know the future, follow me, right? Because I actually have the tools to do it. Now, a lot of real estate agents say, I don't have a crystal ball. True, they probably don't have crystal balls. I don't have one either. But my forecasts tend to be extremely accurate because I have the theoretical and applied knowledge about how to look at the environment, the things that are taking place in the environment in order to make the forecasts. And so that's what we're doing here. Now, first things first, before we start making forecasts about the future, we should level set where are we as we approach the end of 2024. 2024 has been an interesting year in many regards, especially as related to real estate here in the Las Vegas Valley. First of all, as we ended November, we were at a median sales price. That's actual closed transactions, what the seller got from a buyer for closed single-family resale homes here in the Las Vegas Valley. We were at $470,000. I do not yet have the December numbers because those won't be coming out for another week. But kind of interestingly, we spent 5 months of 2024 at that same median sale price of $470,000. Now, we had actually gotten up to 470. We spiked higher to 480 1 month. We came back down to 470, and this is the end of November. This was the fourth in a row, the fifth overall month at $470,000. So in some manner, a very stable pricing market for single family homes. And so we're actually up about 7.6% on median sale price for single family homes in the Las Vegas Valley during the course of 2024. Now that's a really healthy gain, right? That's above normal gains, where in a normal year we might be seeing 5 to 7% price appreciation. We actually saw 7.6% through the end of November. Possible prices will go a little higher in December or a little lower in December, just because of normal fluctuations. If there's a major change after I've recorded this, I'll add it in the notes near the top of the notes. So you can look out for that, but it's unlikely that there's going to be a substantial change in median sale price. Now, I will tell you, single family sales were very slow. So 2023 was actually the slowest sales year that we had in a generation here in the Las Vegas Valley. Through the end of November, we are up 0.4% or 90 sold single-family resale homes in the Las Vegas Valley. We'll see how December looks. It might be that we actually end up below 2023. We might remain slightly above 2023, but transaction volume has been extremely slow. I will note townhome sales down 9.3% this year from what we saw in 2023. Condo sales were up 6.1% from what we had seen in 2023. So that's kind of interesting. But in the aggregate, that means that we were up 91 housing units across the entire Las Vegas Valley from 2023 to 2024. Again, 2023 was record low transaction volume, and so 2024 has remained at this bottom of an extremely slow market. But having said that, demand has actually held up well, especially when we consider interest rates. So where are interest rates as I record this? Well, the average interest rate for 30-year fixed rate loans across the entire country for the entirety of 2024 through the end of November, actually through the first half of December, 6.72%. That's a pretty high interest rate, and if you've been watching my market updates every month, you know that we've been about 7% plus or minus 0.3% for mortgage rates all year long. Well, it turns out that our average through the middle of December for 2024 has been 6.72%. So we're right there within that range. How does this compare with 2023? 2023 was 6.81 across the entire year. So we are down 9 basis points, less than 0.1% on the 30-year fixed rate loan average across the year 2024 relative to 2023. So interest rates have remained really high. If you go and you look at my forecast video for 2024 that I recorded a little over a year ago, you'll notice in that I suggested I believed interest rates would come down. Probably in the second quarter, we would start to see some significant move down supported by Federal Reserve reductions in the Fed funds rate in the third quarter of 2024. Did not come to pass. The Fed started to cut the Fed funds rate on September 18th, so the beginning of the fourth quarter, so they're an entire 3 months late from what my forecast was. But the other issues that would pull interest rates lower failed to materialize during 2024 at all. So interest rates remain high. We'll talk about what I think interest rates are going to do in 2025 in just a couple minutes. Now, one of the impacts that I've noted all year long, in fact, for the past couple years, is these high interest rates are actually counterproductive for trying to do something to stabilize pricing in the market. Right? We're going up a lot. So many people are complaining, well, houses are just really expensive, especially when you consider the carrying costs. And there's truth in that, right? Well, what do we need to overcome that? We need more. We need more production of more houses. Just plain and simple. Well, how does new construction look? Not here in Las Vegas, but nationally. We are down at the end of November. We were down 1.8% month over month. So that's from October 2024 to November 2024. And we're down 14.6% from where we were in November of 2023. So new construction is the answer to the problem, but new construction is being hampered. Why? Because of very high interest rates. And this is what I've been saying for a couple of years now. The Federal Reserve is shooting itself in the foot, harming the housing market because they're keeping interest rates high, which is making it more expensive to build new construction housing. And so that's pulling down the amount of new construction that we're actually seeing. That's impacting here in the Las Vegas Valley as well. New construction, clearly significant to our economy here, clearly significant to housing, but new construction is running way below what it should be given the shortage of housing that we have here in the Valley. Now, one other point that I want to make about 2024 before moving on, and that is there's a disconnect between buyers and sellers in this marketplace. It's being exacerbated by really bad information being given from listing agents to sellers, or from sellers just reading, listening to YouTube, whatever, and finding bad information. The median list price at the end of November was $550,000 on single-family resales here in the Valley. The median sold price, $470,000. That means there's a gap of $80,000 there. Now, it does not mean that every single house is mispriced by $80,000, but in the aggregate, that's the median displacement, which means that a lot of the inventory that we believe is sitting out there, looking at just straight inventory numbers, is actually illusory. It's not priced in any kind of manner that we'll ever get a deal. The actual adjusted, renormed listings that are sitting out there, taking into account an appropriate listing price, is actually $3,250. That's less than 1/3 of normal inventory for resale homes in the Las Vegas Valley. So inventory remains really tight, interest rates remain high. We do have transactions taking place, although at a slow level, right, equal or approximately equal to what we saw the year prior, the slowest year in a generation. But prices keep moving up. What's that say? That says that looking at 2024, there are people who need to buy, there are people who need to sell, and those people are getting into transactions or closing those transactions, and that is what's taking place in the market. Normally, in the real estate market, we have both those who need to move and those who would like to move, not need-based, but desire-based. Well, most of the desire-based part of the market simply did not exist in either 2023 or 2024. Well, let's find out what's going to happen in 2025. So let's turn our attention real quickly to macro issues. Now, with regard to macro issues, there are sort of three things to take into account. One is obviously the interest rates. Interest rates remain very high. Now, the Federal Reserve in September cut the Fed funds rate by 50 basis points, 0.5%. In November, they cut another 1/4 point, and in December, another 1/4 point, which means the federal funds rate has actually come down 1% during the fourth quarter of 2024. Well, that sounds really good. The problem is the Fed funds rate is the overnight rate that is published by the Federal Reserve for banks to lend to each other. It's not connected directly to any of the other interest rates, specifically to 30-year fixed rate mortgages. So what happened when the Fed started cutting rates for the Fed funds rate? The only interest rate they specifically control, mortgage interest rates actually went higher. Why is that? Well, it's because the Fed's making a couple really big errors in their calculations here. The most significant of which is the Federal Reserve in 2001 tried a little bit of experimentation, did it a lot during the Great Financial Crisis in 2008, and has done it again with regard to sort of this inflation scare, I guess we'll call it, in 2021 and 2020 through the end of 2024. And that is what's referred to as quantitative easing or quantitative tightening. So in addition to controlling the Fed funds rate, the Fed can go out and buy up or sell off a lot of bonds, a lot of loan products that are out there. So those could be treasury bonds issued by the US government. They could be mortgage-backed securities. They could be consumer debt, meaning credit card type debt, car debt, etc. Generally, you've got what are classified as government debt and agency debt. So the Federal Reserve, when they're trying to loosen monetary policy, can start buying up bonds, buying up debt. What does that do? It pushes a lot of money back into the economy. Now, remember, the bond price and the interest rate move inversely. As the Fed is buying debt, what they're doing is they're increasing demand for bonds. Increased demand means that prices of bonds move up, but the interest rate moves exactly opposite. So the interest rate comes down. So the Fed is not only putting money into the economy, they're boosting demand for bonds, which is lowering interest rates directly. That's quantitative easing, and that's what had happened when we went into the pandemic. The Fed decided they needed to ease monetary policy as quickly as possible. So they cut interest rates, the Fed funds rate, dramatically, and they back that up with quantitative easing. Well, since the middle of 2022, the Fed has engaged in quantitative tightening. What does that mean? It means they're taking the portfolio of bonds they had purchased and they're selling them off. Treasury bonds, also agency debt. And they've continued to do this even now that they've started lowering the federal funds rate. They've continued with quantitative tightening by selling off parts of the portfolio, specifically agency debt looking like mortgage-backed securities. And so that's caused mortgage interest rates to move back higher because the Fed, while they're saying out of one side of their mouths that they're cutting interest rates, Fed funds rate, the only interest rate they control, what they're actually doing is they're engaged in quantitative tightening, which is pushing mortgage interest rates higher. Now, I can't explain why the Fed is wanting to do this. It makes no sense. It's contraindicated by what they're talking about. It's contraindicated by the impact it's having in the housing market, where the primary source of inflation throughout 2024 was actually the housing market. So the Fed is doing things that are exacerbating the inflation problem they're trying to overcome, and they're keeping interest rates really high. And this is incredibly problematic. It's problematic from a public policy perspective, not just that the Fed is doing this kind of thing, but it's making housing more expensive when housing is actually the #1 source of wealth creation in the US economy. And so it's causing some people not to be able to participate in gaining wealth that they otherwise would be able to. And it's causing other people, large institutions, for example, to be able to capture a greater share of the housing wealth than would otherwise be the case. This is, from a public policy perspective, this is actually really, really bad. From an individual consumer perspective, it's not good. It's making housing more expensive for you who may want to be buying a house. It's making housing more expensive for you who might want to sell a house and buy another house. Okay, the interest rates looking forward through 2025, right? Maybe the Fed changes his mind. I don't know, hopefully. But there are a couple things that have a significant impact on the federal funds rate, what the Fed decides to do with its signaling rate. And that is things that are inflationary cause the Fed to become more concerned about inflation, pushing up the Fed funds rate, which signals to the overall market that maybe interest rates across the debt complex may be moving higher. So unfortunately, the new incoming administration is pursuing 3 policy objectives. Now, we don't know at what level, we don't know how far the administration will go with these things, but all 3 of these policy perspectives will create inflationary forces. So one of those is tariffs. Well, tariffs is basically a tax on the importation of things into the U.S. That tax ends up being pushed through at some point to some consumers somewhere, right? So it's a tax, though. It's a tax on people who buy imported products. It's not a tax on a foreign country. If we could tax foreign countries, that would be great. We could solve all budget deficit issues really simply. We just tax other people, right? People not in the U.S. The taxes don't work that way. If they did, the world would look extremely different than it does. It doesn't look that way. Countries can only tax their own citizens. And so the tariff is actually a tax on U.S. citizens who are importing things from overseas. Well, that tax causes the net effective price of things that are imported to go higher, possibly also causing prices of things produced domestically to go higher because domestic producers realize, oh, we have room, we could actually increase prices because the imported products have gone up in price as well. Well, that's inflationary. So that's an inflationary policy that the incoming administration has said that they want to pursue. Second, tax cuts. So we know that tax cuts increase the size of the deficit because tax cuts are not sufficiently offset by either additional growth in the economy or by other forms of revenue or expenditure cuts. And so tax cuts tend to be inflationary, maybe minor. We don't know how big tax cuts are going to be, how they'll be directed, et cetera, but let's just take a consumer who gets a $100 tax cut Well, now they have $100 more in their pocket for which they could spend, or with which they could spend that money on things that they want. Well, in the aggregate, that means all of the people have $100 more in their pocket to go out to buy the limited number of things that are out there to buy, right? So tax cuts literally are inflationary. The third policy desire is with regard to deportation. So this may or may not come to pass. It may or may not be a large thing. But if we start moving workers, assuming that some number of deported people are actually working people, if we move workers out of the economy, that's going to cause labor prices to go higher because we have fewer people doing the jobs than what we had before. So that pushes wages higher. That, again, is inflationary. All three of these major policy desires are inflationary. That suggests that inflation in 2025 will be going higher, which, if the Fed continues to maintain its target of 2% inflation, I suspect they're actually going to shift that to a 3% target, which is more in line with what the Fed has always had as a target around inflation. If they keep their 2%, that means they're going to have to increase interest rates significantly. Even if they increase the target for inflation to 3%, which we're running a little below right now, we will still find that inflation is increasing and that interest rates will have to move higher later in 2025, probably much more so in 2026. So inflation will be induced, and inflation drives interest rate issues. And so interest rates will not be coming down in 2025. Maybe there'll be one rate cut at the beginning of the year. Maybe there'll be two at the Fed funds rate, but not at the mortgage interest rates for a variety of reasons. And so that means we're going to not see reductions in mortgage interest rates in any meaningful manner during 2025. Employment levels. So if interest rates are too high, that cuts into the employment levels. This is another macro issue. If unemployment were to increase significantly, unlikely, but could, especially if the Fed increases interest rates so much so that it induces recession, that would cut employment levels, it would increase unemployment. Employment levels are significant to the health of the housing market. And the next issue at the macro level is regional mobility. How easy is it for people to move from one region, maybe the Northeast, to a different region, maybe the Southwest? Right? The easier mobility is, and historically the US has actually had a very mobile population, the easier it is for people to move between regions, the easier it is for them to pursue particular jobs that might be of interest to them. Well, that increases the size of the economy in some areas and decreases the size of the economy in some other areas. Las Vegas historically has always been a rapidly growing environment, a rapidly growing economy. We can find certain very small exceptions in the 2006 to 2010 timeframe, but that's about it. Las Vegas has grown at very rapid rates throughout its entire history, and that's likely to continue. But the higher the interest rates are overall, that also restricts the regional mobility. It makes it harder for people to find the housing. It makes it harder for employers to hire new people, et cetera, et cetera. And so regional mobility at a macro level could significantly impact it. Well, could marginally impact us here in Las Vegas Valley in 2025. Okay, what are the other things that really are significant? The local economy. So it's not just the macro economy, but the local economy. And so I want to talk about this for just a couple minutes because it's really interesting. In the local economy, we have the potential for significant infrastructure investment or not, for significant industrial investment or not, significant housing investment or not. And so let's take a little bit deeper dive into several of these regional or Las Vegas specific economy issues. So the first one of those is infrastructure investment, right? This is the building of new roads, the building of new airports or expanding of airports, the building of train lines, all those things that are the infrastructure across which the economy moves. Right? It also includes softer investments, infrastructure investments, like putting in new gas lines or new sewer lines, putting in new telecommunications lines. Right? Those are all infrastructure type investments. Well, in Las Vegas, we've seen a lot of infrastructure investments over the past couple of years. The widening of pretty much the entirety of the 215 freeway, as well as the completion of the 215 freeway on the north side of Las Vegas. That's continuing. We've seen the widening of the I-15 freeway from effectively downtown Las Vegas north, and that's continuing in 2025. We've seen significant freeway investment on the I-15 south of the Strip area, actually as well, because we've seen the creation of the St. Rose Parkway, Southern Highlands Parkway off-ramp. We've seen the Star interchange added, the Cactus interchange added, et cetera, over just the past several years. Well, right now we've got a significant freeway widening environment that will go all the way from effectively the California border to the 215 freeway. So that's going to be widening by 1 or 2 lanes on each side of the I-15 freeway, access from Southern California into Las Vegas. And of course, we've been watching the rather disruptive, to say the least, expansion of the I-15 Tropicana interchange. That work is scheduled to tie up around the end of 2025, which will be fantastic. That'll be a major infrastructure improvement that included the adding of the Harmon on-ramp and off-ramp onto the south side of the 15 freeway. Well, the price on that alone is about $385 million and may actually escalate a little bit further. Brightline, the high-speed train to Los Angeles, actually just to Rancho Cucamonga, with then a tie-in to the Metroliner in Los Angeles, so that people could ride all the way from downtown LA, or actually LAX, into Las Vegas. $12+ billion investment. This has had construction activity taking place over the past couple of months, which will significantly intensify during 2025. It's supposed to be completed in time for the LA Olympics in 2028. We have a major expansion to the Las Vegas airport, the Harry Reid International Airport, which has been announced, although time has not yet been put on it. It's likely to start seeing activity in 2025. The plan is to expand the number of gates from 39 to 65. This is a multi-billion-dollar investment in effectively the downtown and Strip area of Las Vegas, but in the overall infrastructure of the region. There is an additional airport that may be built south of Las Vegas, but that's more than a decade away. So this is actually designed to relieve a whole lot of the problems that the LAS, the Las Vegas Airport, has been experiencing as it reaches its capacity. It's one of the very fastest growing airports in the entire country. There is some level of quasi-private investment in infrastructure with the Vegas Loop. We'll see what actually happens with that. It's an unusual way to make mass transit, to do it one car at a time in tunnels underground. But this has actually been approved for multiple billions of dollars of investment over the next couple of years, including significantly in 2025, connecting the airport all the way up to the throughout the Strip, over to the sports complexes, and to downtown, and then over to the new medical school area for UNLV. But it's not just infrastructure. So we have professional sports investments that are taking place. The A's ballpark will have a 2025 start. It's a $1.4 billion investment into Las Vegas. The NBA is likely to announce expansion plans in 2025, and the very odds-on probability is that Las Vegas will be getting the expansion team. There are a couple of different possibilities for NBA arenas, two of which may be connected to resorts that would like to break ground and start. We'll see what happens on that, but that's a major multi-billion-dollar investment that will be coming to Las Vegas, that will be starting in 2025. And then, of course, the F1, it continues expanding with its own building, which is becoming an entertainment complex, which will be kind of interesting as well. That's close enough to the convention center that may actually be incorporated for some convention activity here as well. Movie industry investment. So there's proposed state legislation to create some tax credits to bring movie production to the Las Vegas Valley. And there are some very serious plans, $8.5 billion from Warner Brothers Discovery to build out a whole studio in and around the Harry Reid Research and Development campus for UNLV on the southwest side. And from Sony Motion Pictures, a $1.8 billion plan for building out studios in the downtown Summerlin area. So significant developments taking place there. If this legislation passes this year for these tax credits, these plans will go into effect and we'll have $10 billion worth of movie studio, right? This is not productions, but this is the studios, the sound stages, the catering facilities, all that kind of infrastructure stuff coming into the Las Vegas Valley to develop what some have referred to as Hollywood 2.0. That's billions of dollars, $10 billion of investment right there. Then we've got convention center infrastructure investment. So we had development of the $1 billion West Hall that completed a couple years ago. We have an ongoing $6 billion project to expand and integrate the North and Central halls that will complete in 2025. So significant money there. And then Resorts World actually is also building out a significant additional convention space, as is the Bellagio and the Venetian. We have medical industry infrastructure investment taking place with a newly announced children's hospital to be built in the southwest portion of the Las Vegas Valley that would be developed with Intermountain Healthcare. That's a multi-billion-dollar investment that will be taking place, and it will be taking place. I don't know for sure it's going to start in 2025, likely, but it may be pushed to 2026. We have the brand new opening just happened in December of the Henderson West Hospital. And we have expansion of residency programs for students trained at the UNLV Medical School as well as other medical schools throughout the country. So a significant push to try to expand the residency programs. And then we have commercial investment taking place into the valley. And that's looking both like new Costco's being built. So the 6th Costco will be opening in the valley by the end of 2025 in the 215 Buffalo area. A major new Ashley's Home Furnishing distribution center and retail complex taking place around that same area to open in 2025. And anywhere you drive, you see major warehouses being built in the southwest, the northeast, the northwest portions of Las Vegas, and these are creating the opportunities for significant logistics businesses to be operating here in the Las Vegas Valley. And then finally, Haas Automotive with its $300 million manufacturing facility in Henderson West. That is actually breaking ground at the very beginning of 2025. It's finally been cleared for all the approvals to start spending money to actually start building the factories themselves. We have a lot of resort industry investment taking place as well. The Venetian has just announced a new renovation valued at $1.5 billion that will be taking place throughout 2025. The Mirage and Hard Rock, the conversion of the Mirage into a Hard Rock will break ground in 2025 with the building of an entirely new tower. The Bally's and A's development, so that's projected start in 2025. So along with the A's stadium being built at Tropicana and Las Vegas Boulevard, there will be 3 towers of a brand new Bally's resort built there as well. That will be built through phases, but the first phase, the first tower, the gaming complexes, all that kind of stuff will break ground in 2025. The M Resort is expanding with a new tower and about 300 new rooms opening in 2025. That's down in Henderson West. Station Casinos just opened in December of 2023, the new Durango Resort, and they have announced that in 2025 they will already be engaged in an expansion project for that for about $120 million. They've also announced a redo, a revamp of their Green Valley Ranch Resort, and that's got a similar kind of value taking place in 2025. So a lot of infrastructural investment across industries, across sports, across movies, across roads, trains, airports, all taking place in Las Vegas, with a huge amount of that money being expended in 2025. That means that the area is growing. It means that there's more employment opportunities here. It means there's going to be more population here, which means we need more housing. And so we've got some kind of interesting housing developments. We've got in the Arts District 2 new high-rises that'll be built. One is a condo building and one is kind of a condo hotel building. Across the freeway from that, we have significant investments going into low-rise and also high-rise condo. Be the first real high-rise condo built in Las Vegas in 1.5 decades. We have the Las Vegas Desert Pines Golf Course, which is being redeveloped into 1,300 new market and below market rate housing. We've got continued major development in new villages in Summerlin, also in Sky Canyon, in Inspirada, in Cadence, Lake Las Vegas, and new master plan communities in the North Las Vegas area. So throughout the Las Vegas Valley, we've got a lot of residential construction taking place as well. But just to level set, that's not enough housing being built to take care of all the demand that exists in the valley already, right? So we do have a lot of apartment complexes being built. You've seen them being built all around. There are corridors of new large multifamily complexes, some condos, mostly apartment buildings. We've got that, which is really good because it's allowing pretty much most of the people who are moving to Las Vegas to have housing, even if it's not the desired type of housing. Ownership opportunities, single-family housing opportunities, townhome opportunities that most people moving here will be looking for. So beyond that then, what are my forecasts for 2025 in housing here in the Las Vegas Valley? Well, policy uncertainty, remember that macro level influencing issue of tariffs, of deportation, of tax cuts, creates some real problems for trying to make numeric predictions for 2025. So I want to start with that caveat, with that note. Nonetheless, transaction volume is going to remain weak. Why? Because interest rates will remain high. Mortgage interest rates throughout the year could come down to the low 6% range if we start seeing a normalization of the gap between 10-year treasuries and 30-year fixed rate loans. Typically, historically, that gap has been about 2%. That gap has widened to about 3% over the past 2 years, primarily due to policy uncertainty with regard to what the Fed is doing and might do into the future, but also with regard to concerns about potential inflation and the Fed's quantitative easing and then tightening, causing some dislocation in the bond market among bond traders. That gap could come down between 10-year treasuries and 30-year fixed rate loans. If it does, we'll see interest rates coming lower for mortgages. but that only takes us down to the low 6%. The reality is that we're likely to not see a substantial closing of that gap, and instead start to see the 10-year Treasury go higher in interest rate yield or lower price because of significant additional issuance of governmental debt, because of the policy prescriptions coming out of the new administration being pro-inflationary and also being pro-expenditure. So that means that we're likely to see continued weak transaction volume, right? The need-based transactions will occur. The I would like to based transactions will remain highly restricted. Do note though, right? Las Vegas is a growing environment and a growing economy. And that means, A, there need to be new houses built, additional new houses built. It means that there need to be transactions that take place as people move into the valley, as people move out of the valley, as people have to, for some particular reason, change houses within the valley. So that means that if we have increased demand because of increased population, increased worker base, and we have limited supply because of restricted construction, because of high interest rates, potentially restricted construction because of higher input costs regarding labor, because a lot of residential construction labor is at risk of deportation. So that would cause labor rates to go up for building of new properties, which causes new properties to become more expensive, which causes a restriction in the number of new properties that can be built, right? Because one, the labor may not be available, and two, is new housing becomes increasingly expensive, it becomes increasingly difficult for builders to sell it. Because at some point, while demand remains, the number of people who can afford increased prices definitely shrinks. And so developers have to offset higher prices for labor, maybe for land, for other materials that are coming in that may be subjected to tariffs. They need to offset those costs somehow. And so what do we see? We actually have seen throughout 2024 increased development of 3-story houses, increased development of apartment buildings, increased development of townhomes with no backyards, right? Cutting down on the land required for those townhomes. Why would a 3-story house be less expensive to build than a 1-story house? You need less land for it. Your concrete pad for the foundation becomes smaller. The roof becomes smaller. Those things that cause the cost to go up start to narrow. So going higher, up to 3, maybe 4 stories, is actually less expensive than going wider and making a property that's a 1-story or even a 2-story house. And so we're seeing this throughout the valley, especially in some of the higher priced areas like Summerlin, where much of the development has now become 3-story single family home and 3-story townhomes. Kind of interesting. So that's what we're looking forward to with regard to new construction, is restrictions on the amount that can actually be built, increasing prices. That's going to increase prices in the resale market, and we'll still see transactions, but they'll be the need-to based transactions. So if I have to start putting numbers around things for you, 2023, generation low in terms of transaction volume. 2024, approximately exactly that same, generational low in transaction volume. 2025, we could see a slight increase in transaction volume based on pent-up demand, but it's going to be really low. We're going to be still looking at very low total housing transaction volume in the Las Vegas Valley in 2025, right? It's the need-to sales that'll take place. It's the want-to that are less likely to take place. Now, so we'll see a small increase in transaction volume. What about prices? Well, for those people who need to buy, they need to buy, and they're willing to pay the prices that are required. For sellers that need to sell, on the other hand, they need to sell, and they're willing to sell at a price that will bring in a buyer. And so we'll see pricing pressures throughout the year. I think we'll actually see pricing go higher. Now, this is contrary to almost every other forecast that's out there, which has been predicting basically totally flat to up 3% on pricing throughout 2025, similar to what others have been predicting in 2024 and even in 2023. My predictions have been different. My predictions were we're going to see substantial increases in prices. In 2024, I had suggested for the forecast for 2024, I had suggested that prices in the Las Vegas Valley could actually go up as much as 20%. Everybody told me that I was simply crazy for making that prediction. Prices were likely to be flat, maybe down 2%, maybe up 2%. Well, prices have gone up over 7.5% during 2024, right? Which means my reasoning was exactly correct. My model was correct with regard to everything except interest rates. Everybody had been predicting that interest rates, the Fed would be cutting interest rates in 2024. And that would be driving down mortgage rates, which would be increasing transaction volume. And somehow people thought that was going to be keeping prices approximately flat. That's not the case. And this is actually the number one risk I have to my 2025 forecast, is if interest rates do something different than I'm suggesting. If interest rates go down to 6.0%, we're going to see a big increase in transaction volume at higher prices. If interest rates were to go below 6.0%, we're going to see exactly that kind of pricing gain that I predicted in 2024 could happen specifically based on lower interest rates, where we're up really substantially during the course of 2025, potentially as much as 20%. However, my base case, the baseline estimate, is interest rates remain approximately flat through 2025 before starting to go higher in 2026. Now, they may actually come down slightly in the first half, go up a little bit in the second half, but we're likely to end 2025 with interest rates approximately where they are at the beginning of 2025, high sixes. If that's the case, slow transaction volume with prices going up in line with what we saw in 2024, up 7.5%. So if you want a number on it, that's my target estimate for where prices will go for single-family resale housing here in the Las Vegas Valley during 2025. Want to find out what's going to happen next year? Well, follow me. Let me just really quickly give you a couple recommendations. Over the past 4.5 years now, we've seen really significantly high contract failures. That's buyer and seller get into a contract and something causes that contract to fail. Find an agent who can tell you why that's happening, who can explain to you why that's happening, who can explain to you what they're going to do to protect you from being in a failed contract situation, and explaining what they will do to overcome the potential of a failed contract should that potentiality actually arise during a transaction that you're involved in. This is really critical. We've been seeing back on market numbers throughout 2024 and 2023 and 22 and 21 that are 3, even more than that, times higher than what they would be in a normal environment. We've not been in a normal housing environment since 2019 in Las Vegas, at least with regard to this metric. Contract failures, called back on market, but back on market actually underestimates contract failures, because if a property does not literally go back into the market, the owners just decide, well, we'll keep it, or we'll rent it out, or we'll do something else. It's not a back on market, it's just a contract failure, and that does not show in the back on market statistics. So these numbers are running really high. Find an agent who can talk to you about it, explain it to you, tell you what you're going to be doing to protect yourself from it, how they're going to advise you around this. Also, because of significant changes that happened on very technical issues in 2024 around how real estate agents are allowed to engage with their clients, make sure that your agent can explain those issues to you. If you find an agent who cannot, That's not the agent for you. Find someone who actually knows what they're doing and knows how to do things and knows how to talk to you about those things that they need to do. That means you're looking for professional agents, not somebody who did one transaction during the course of the year. By the way, as we approach the end of 2024, 47% of realtors, that's the most serious type of real estate agent, realtors, that means that they're members of the local association, means they're members of the National Association of Realtors. So extra fees, extra education, et cetera, 47% of realtors have not done any transactions in 2024. That's just the reality. One in two realtors you talk to, one of them hasn't done anything. For Chong Miller Group, for me, this has been actually my second best year that I've had in the industry. 2021 being the best year, 2021 being actually record sales volume for the entire valley. So 2021 was an exceptional year, where 2023 and 2024 have been exceptionally slow. This has been a great year for me and my business, including 2 of the busiest months I've ever had in real estate. That means I'm seeing transactions all the time. I'm seeing what's going on with transactions. I'm seeing what's taking place in the conversation around pricing, around solutions to problems, and I'm keeping my clients out of trouble. Well, there are probably a few other real estate agents who are equally qualified. Find me or find them and make sure that you're able to gain advantage from them. Just one other comment and then we'll be done. And that is, if you have the capacity or if you have the desire to buy a home and you don't already have one, find a real estate agent, me, one of the other few, who can explain to you the value of the purchase of a home, who can explain to you maybe ways that you can get into a home that you hadn't been able to think about on your own, because owning real estate is truly the #1 wealth creation vehicle available to almost everybody in the US. Almost everybody who builds wealth in the US does so through owning of real estate. A statistic, owners of real estate have 40 times greater net worth, that's an economic value, than those who rent. Now, there can be great reasons for renting, and I don't want to tell any of you not to rent, but if you have the capacity to buy, you want to make sure that you're checking off all the boxes necessary to make an informed decision about whether or not to buy, whether or not to rent. Because owning a property is astoundingly valuable to you. And as property prices go higher and higher, becomes actually even more valuable to you, not just because the price of your property went up, but because the differential becomes greater between those who are able to own and those who are finding themselves not able to own, which could be only an issue of differential advice, right? What you're actually finding out about what you can and cannot do. Okay, so I am Justin Miller. I'm the principal and co-founder of Chong Miller Group. Please subscribe if you've not already, smash the like button, hit the notification bell if you find these videos helpful. Every month I do a market update to let you know what's going on in near real time for single family houses in the Las Vegas Valley, also a companion video most every month for condos and townhomes. Please as well, if you have family, friends, neighbors, colleagues, anyone who you think might benefit from having a real understanding of what the real numbers are about real estate, being able to make an informed decision as opposed to just simply guessing about what's going on, please share my videos with them. They will benefit a lot, just as all of my clients have benefited. All right, real good. I'll see you in the market update videos. Take care and have a great 2025.